Welcome back. Earlier today, the Federal Reserve met during the regularly scheduled meeting and left interest rates unchanged as expected at the 525, 550 level. But as reported on CNBC, traders' attentions turned to policymakers' forecasts for rate cuts, including three in 2024. And that really is the news. We were expecting up until this point two rate cuts, 25 basis point each. Now we're looking at possibly three, and they report four more cuts in 25, and possibly three cuts in 2026. Well, this is what the Fed funds futures look like just the other day, December 11th. The green line represents the probabilities that the Federal Reserve will reduce interest rates. And at that time, it showed us a 46% chance the Federal Reserve would cut rates in the March meeting, a 79% chance they would cut rates in May. So the feeling was at that time, December 11th, just the other day, we had less than a 50% chance the Fed would cut rates in March. Well, now that has changed. There is currently a 73% chance the Federal Reserve will cut rates in March. So the futures market has drastically moved in the direction of reducing rates sooner and reducing rates more often than expected in 2024. Federal Reserve also said that they're willing to cut rates even if the U.S. economy does not dip into a recession in 2024. Chairman Powell said it could just be a sign the economy is normalizing and doesn't need tight policy. Now, again, as of December 11th, this is what the Fed funds futures look like. The gray area chart in the background, that's the S&P 500. The blue line represents the basically the chance that the Federal Reserve will keep rates unchanged at the 525 to 550 level. And this is as of the next meeting, which is obviously in January. The yellow line represents a rate cut of 5 to 525, and the red line represents a 550, 575 level, which would represent a rate hike. So there's virtually no chance of a rate cut or rate hike. But what we spoke about just the other day, it's actually very interesting. As the anticipation of lower rates approaches, we see strong stocks. We're now seeing quite a strong correlation, and this is what it looks like right now. Notice the difference between the other day and today. The gray area chart is the S&P 500, and we broke to new highs, new all-time highs in the Dow Jones Industrial Average. Not yet on the S&P, but it's not far away either. So just as we spoke the other day, as we see signs the economy is cooling, the Federal Reserve is moving closer to the idea of cutting rates and cutting rates more than we thought, and stocks seem to like that. Furthermore, the Federal Reserve said it indicated it could be cutting its key interest rate by 3/4 of a percentage point in 2024. Following the Fed meeting, traders in the Fed funds futures market were pricing 150 basis points or 1.5% worth of cuts in the year ahead. So we certainly have moved up in the expectation of rate cuts. And again, Dow Jones Industrial Average up big today, uh, hitting levels we've never seen. These are historic highs. Speaking of cooling economies, it was reported U.S. wholesale inflation dropped to 0.9% year over year November. That was helped in part by tumbling energy prices. This is reported on CNN Business. And that was to bring down U.S. inflation below pre pandemic levels and to its second lowest rate this year. Now, specifically, what we're talking about on a month over month basis, you can't really see it because it's unchanged. PPI, Producer Price Index, zero point 0.0. Core PPI, excluding food and fuel, the more volatile components of the inflationary number, also zero point 0.0. The red histogram bars show us on a year over year basis, 0.9% on PPI, almost 2%. That's 1.97% on a core PPI. So just like the CPI, the Consumer Price Index we spoke about the other day, the Producer Price Index, which measures the price of goods at the wholesale level, it's declining faster on the standard number, the PPI. Core PPI excluding food and fuel, not so much. So what does this tell us? Food and fuel is leading the way lower. Now here we see the red histogram bar show us PPI. This is month over month levels, and that's core PPI. The standard PPI is in white. And what we can see are more negative reports here, negative numbers. Now, of course, this month was 0 0 on the core and standard PPI number. But notice what we're seeing now is that we're seeing consistent declines in wholesale prices. And this really is sending a signal to the Federal Reserve, and they have received that signal. Here we see yellow PPI year over year, red CPI year over year. Now, red is a consumer price index. That's the measure of the basket of goods or services that we as consumers pay. The PPI is the wholesale prices. The gray lines in the background, that's the Fed funds futures, again, unchanged. Now, what we're seeing is the producer prices are declining even more than the consumer prices. So it's thought that if producer prices go down, they'll pass on the savings to the consumers. They have to, because if they don't, their competition will. Here we see PPI year over year versus crude in red. This is crude oil, and energy prices and food prices are certainly contributing to weaker overall wholesale prices. If you exclude food and fuel, well, then producer prices are still declining, but not as much. So, and I think that's a good thing to measure the crude oil, gasoline prices, energy prices, food prices, because if we think about it, those are the prices that we as consumers encounter every single day when we go shopping or we fill, the car up with gas, whatever it may be. The price for shoes, the price for, rent, things of that nature, we don't necessarily encounter every single day. So we see core PPI really charging to the downside, and that's led by crude oil. Now, an interesting dynamic is we take PPI minus CPI, that's in red. So we have the producer prices, those are the prices that the manufacturers pay. We subtract out the consumer prices. If the line goes up, if the red line goes up, it means the producers are paying more and they can't pass on those extra costs to the consumer. This is actually what we were looking at this time last year. The white line is the S&P 500, and what's very shocking is a very strong correlation, at least up until this point. When the producers were paying more, the consumers, in essence, were getting a little bit of a discount. Not that it felt like a discount to us, to the consumer, but the fact of the matter is the producers can't pass on the extra expense to the consumer, and ultimately that benefits the stock market, that benefits earnings, so to speak. Now, conversely, when we see the PPI, the producer prices go down, that tends to correlate also with the stock market. Up until recently, though, notice the disconnect. And this is something we've spoken about before. We cannot speak about it enough, though, that beginning around June of 2022, the beginning of the inverted bond market, we began to see a massive divergence as stocks go up and a lot of other economic barometers go down. Now, if history is any judge, and any guide, we expect a regression to the mean. Meaning we expect either stocks to come down or these economic numbers to improve, because after all, there was a very strong correlation. Why the disconnect now? Is this just maybe something that happens as a result of an inverted bond market? Maybe the economics get distorted to an extent. We're going to dive into this with a lot more detail because I don't know that the answer is very clear. But nevertheless, we should make note that PPI minus CPI is dropping. We would logically expect consumer prices to come down as well. All of these numbers, the CPI the other day, the PPI today, it's sending the Federal Reserve a message loud and clear, and they're receiving it loud and clear. Cut rates. cut rates sooner and more than we expected in the past because the economy is cooling. Now, the Federal Reserve, if you read into it, they're not concerned about the labor market. They're not concerned about the economy. They just feel it's appropriate not to raise rates anymore. But you be the judge, and please feel free to tell us as well. Do you think that the economy is cooling, or is it cooling a little bit faster than we would like to believe? So we have more economic numbers of quite significance in the days to come. So we'll be sure to update you those along the way as well. But to sum up, the Fed keeps rates unchanged, but is aggressively moving towards reducing interest rates. Now over a 70% chance that will take place as soon as March. And cooling consumer and producer prices certainly give the Federal Reserve reason to believe so. We hope this has been helpful. We look forward to seeing you back soon.